Welcome to another Portfolio Solutions quarterly market update for Q2 2024. I'm Rob Currie, and today we will explore comprehensive insights into the evolving financial landscape, helping investors like you navigate the complexity of today's investment opportunities. For those of you who don't know me, I'm a portfolio manager at Louisbourg Investments, and Louisbourg manages the Portfolio Solutions at Assumption, and pretty much all of our funds are available on a standalone basis. Our diversified portfolio offerings, our portfolio solutions we call them, are designed to meet varied investor needs. The Smart Series portfolio, for example, is really for simplifying investing with a set and forget strategy, ideal for those seeking long-term, hands-off investments that change automatically as your clients get closer to, say, retirement. The traditional and select portfolios offer a broad range of choices to help you balance risk and return effectively. Meanwhile, our individual funds are perfect for those looking to customize their investment approach, providing the tools to build a portfolio that's uniquely yours as an advisor. We put a lot of time and energy into the portfolio solutions, though, making sure that they are the best possible portfolios for you as a partnership with you as an advisor. And we use both Louisbourg funds and also funds from third parties like CI and Fidelity, and as I'm sure you're aware. If we kind of double click on these portfolio solutions for a second, really I wanted to frame what it means to build a portfolio. Building a portfolio is a goal-driven exercise. Is the goal funding retirement? Is it wealth preservation? Is it something else? Each solution is aimed at a different goal, and we feel the best tool for investments that have a date in mind, let's say, for example, I want to retire in year X, should use the Smart Series target date funds. For those who don't have a changing risk profile but are looking for something more static, the traditional or the select options fit nicely there as well. So you can always reach out to your BDM if you want more information on that. But let's talk about the markets. If you've watched these videos before, I've been talking a lot about fixed income and how going forward we should expect better returns. This is what we've been seeing throughout the last year. Again, this is in large part driven by the fact that the underperformance in bonds has been driven by increasing interest rates. Now that bonds offer higher interest rates, forward-looking returns will reflect that. Returns will be even greater if we start to see even larger declines in interest rates, which we'll talk about here throughout the presentation. On the equity side, the U.S. continues to outperform other geographies dramatically, but this has really been driven by a handful of very successful stocks, and we'll go through how to think about that, what it means for investors throughout the presentation. Sticking with fixed income to begin with here, the Canada sovereign yield curve, which is a key indicator for fixed income investor expectations for interest rates and inflation. This is kind of what we're looking at here. Rates had peaked last October and have since come down, which is not new. But as we will see in the preceding slide, we'll kind of look at a history of what that looks like and what's the volatility that we've seen this past quarter. But comparing today's yield to yield curve, to the end of last year, you can see that the short-term rates have fallen while longer-term rates have actually risen. But in the quarter, they declined overall. So this just shows that, again, we're really just highlighting that there's been a lot of up and downs in interest rates, and so for the year we're a little bit higher, but or for like since the end of last year, a little bit higher, but for this year, for this past quarter, yields did come down slightly. Now, one of the things I've highlighted in the past is that spread between the U.S. and Canada, and this is still quite wide, although it's come down from the 90 basis points it was last time I gave this presentation. So rate cuts, which this is kind of a more explicit view of what we were just looking at, but for rate cut expectations, we started the year expecting 6 in the U.S. and 5 in Canada. Now, last presentation I gave, we fast forward to that, we went down, it fell dramatically to 1.5 and 2.5 in U.S. and Canada. Today, now we're expecting 3 in the U.S. and just over 2.5 in Canada. I know I've been a bit redundant here, but really these past 3 sections they've all looked at the same point, but from a different lens, and really that lens is that interest rates have been volatile, but are trending down, which is positive for future fixed income returns. And should translate that way. Now, interest rates are significantly influenced by the rate of inflation, so let's spend a minute looking at the current drivers of inflation. Core goods prices are now falling. Most retailers have begun discounting and releasing inventory. Now the supply chains are back to normal for most industries, and this is putting pressure on prices. Housing services, the price growth there is slowing, though still contributing more to inflation than in the past. We'll dive deeper into this on the next slide, actually. But lastly, core services, ex-housing, is still quite sticky. The labor market is finding a better balance, but it is still quite tight. I mean, we've seen a small uptick in unemployment so far this year in the U.S. from 3.7 to 4.1% in June. And it's important to note that the Fed's long-run sustainable level of unemployment is 4.2%, which we're pretty close to, and that's also where the CBO puts the natural rate of unemployment. So we should start to see wage pressure soften. To put that in context, hourly wage growth in the U.S. is currently about 4%. So one of the large drivers of inflation right now is services, as I said, and in particular housing services. The Federal Reserve in the U.S. uses PCE instead of CPI for their analysis of inflation. But what they show with this chart is that real-time inflation in rent or other housing-related items, it's always kind of been a forward-looking indicator for the impact on reported inflation. Reported inflation has lagged actual inflation, if you will. Where actual inflation peaked in 2022, for these measures, the reported inflation peaked in 2023. Now we're seeing many measures in real time for real-time prices, like as the Federal Reserve is actually showing in this slide from their monetary policy report to Congress, that housing service inflation it should be trending down even further in the coming months, just given where the real-time numbers are. I could show many other charts that add credibility to this idea of inflation slowing and some that remove credibility from that idea, but in general, the market feels as though inflation is trending in the right direction, hence the expectation for rate cuts this year. Switching gears to equities, the bifurcation between markets has continued to exacerbate. When examining equity market valuations, we find the S&P 500 notably more expensive than its counterparts. I keep coming back to this chart because a lot of pundits try to use this to tell a story about where you should be investing right now. In reality, the U.S. has more exposure to technology companies and companies with artificial intelligence tailwinds. But if we were to examine the valuations of similar companies in each region, the differences probably wouldn't be that much. What is true and important to acknowledge is that the top 10 companies in the S&P 500 by market cap are creating a lot more concentration in the index than has been in the past. This means a large portion of returns in the future for the S&P 500 will be driven by the top 10 stocks. So just to show one vantage point of that, here's a chart that highlights this, where the equal weighted S&P 500 is up about 15% in Canadian dollars over the past year, whereas the S&P 500, which is weighted by market capitalization, is up about 30% Canadian dollars. This is even more true when we think about over the past year, the year-to-date performance, which during the second half of 2023, both indices performed similarly. It's really been a 2024 phenomenon and has been driven by a handful of outperforming stocks. It's important to point out that we at Louisbourg have made significant moves in the U.S. portfolio so far this year. I do not have this same concentration, but what this means is our returns and the S&P 500 returns are likely to look very different over the next 12 months, for better or for worse. And then here's one last way to look at it. If we look at the S&P 500's top 10 holding concentration over time, it was going from just under 20% in 2010 to just over 35% today. So quite a leap over the past decade plus. What about political risk? When it comes to political risk, there will be much speculation from pundits on which stocks will do better under which presidency or how the market in general will fare. Both outcomes have offsetting positives and negatives, in our opinion. With Trump, we might get tax cuts that are highly stimulative at a time where we're trying to cool the economy, and tariffs, which are inflationary for inputs. This could reignite the need for higher interest rates and create some noise as businesses would surely benefit, but as I said, there's pros and cons. With Biden, we might get more government spending on social programs and infrastructure, but less investment from businesses driven by less favorable business regulation and higher taxes. So this could also create some noise. Ultimately, the president is supposed to implement regulation created in Congress. Therefore, we view large changes in the makeup of Congress as a more likely catalyst for diverging market behavior over a long period. There may be volatility one way or another, but we're not assuming any significant change over the medium term. In conclusion, we find fixed income attractive here, given the higher expected returns from higher interest rates. Volatility could still be heightened, given the inflation outcome remains still unknown. However, if inflation comes down more materially, we should expect even better fixed income returns from falling interest rates in tandem. Equities have had quite a run, but the breadth has been limited, highlighted by a few AI-driven stocks in the U.S. We continue to find companies with attractive valuations across our geographies, and therefore reluctant to assume that there should be a large pullback in our portfolios. We hope you enjoyed this quarterly update, and we look forward to speaking to you more in the future.